Peter Rose, Longwood currency trading. It's middle of, slipping more toward the end of April of 2021. We have come out of a really cold spell. We've had a fire on the wood stove a couple of nights, and so coming out into a nice warmer day today, very windy though. I thought a topic that I've been asked about on through some emails and stuff is the difference in trading when there's a trend going on and trading in the chop. But before that, we have a task to do. We got to go outside and check the new wood supply. Time to go out again. And the Bow Dog's with us. Well, we're outside, and grass, no snow. We had a snowstorm yesterday. I'll put a picture of that up on the video. But right now we're going to go out and check the wood pile because I just had 3/4 wood dropped. It's easier in the spring to get your wood for the following year than it is to mess around with it later in the fall when everybody wants their wood and prices go up as well. But there's the new wood pile. There's what I've got, and here's the new one. Let's just go around on the other side and check this out. Oh yeah, that's a thing of beauty. We're all set for that. So you might ask, what does a wood pile have to do with currency trading? Well, let me tell you. It's stacking the wood pile in preparation for the winter. So there was a lot of activity, stacking and buying and all that other stuff to get this stuff here. And now it's going to sit there because it's got a season, because it's not for this year, it's for next year. So that's going to season, and we'll use the other pile. And those are the two different kinds of, what does price do? What does price do? There's only two things that price can do, and it's not go up or go down. Price can either trend or it can go into a chop. And so there's a lot of discussion in the educational world as to different techniques as to whether the price is trending or whether it's chopping. And you need to have that if you believe that those two things are different. Because actually a trend, as you would identify it with say a 55 or 200 period moving average, depending on the time frame that you're looking at, could be a 20 period. If that is constantly moving in an upward direction, you've got an uptrend, or downward, you've got a downtrend. And if it's moving basically flatline, then you're in a chop. Price is just chopping around that moving average. You would say at that point that the price was range bound, and the concept of trading levels comes into play, support and resistance levels. I mean, you could still trade support and resistance levels in a trend, so you've got two commonalities there. You do have the component of a continuously rising trend, and so therefore you have to do multiple time frame analysis to make sure you're trading with that trend and all the other stuff that goes with that. But is that really any different than if you're trading in a chop? If you're trading in a chop, you know that you really have a parallel price action going on, but it's still oscillating. It's like a horizontal sine wave, and it's oscillating between two different levels. This is a resistance level at the top, support level at the bottom. Well, in the process of going from the support level to the resistance level, guess what? That's a trend. Now, if you're on a 5-minute chart and trading that, and your support and resistance bounds are found on a 15-minute chart, you might have a, I don't know, 30, 40 pip spread between resistance and support levels. Well, if you're a long-term trader, that's of no interest to you, because you're looking for a couple of hundred pips at the least, and you'd want to leave your order in for a week or 2 weeks or something like that. I'm in a long-term trade now. I've been in it for 3 weeks. So there's nothing to do except sit at the screen and watch it. But the issue becomes one of what's the distance of that trend. Again, if you're a long-term trader and you've got a trend between the two boundaries of 30 pips, and you're looking for a 200 pip gain, then you're going to be very happy when it goes from the support level to the resistance level on that 15-minute chart or hour chart or whatever it is. But then that's going to turn around and it's going to go back against you. 30 pips. And then it's going to go again in an upward direction. Now, if you're looking to trade the breakout, then you'd wait until the breakout occurred. But if you were in a trend environment, you'd be looking for a swing point. You'd be looking for a reversal, a head and shoulders, or some stupid freaking technical indicator like that, in order to indicate the directional change. I guess the long and the short of what I'm getting at is that it makes your trading so much simpler if your methodology does not include a differential analysis between a trending price and a chop. Why complicate your life? Even if you're a long-term trader and there's this long-term trend, that trend is ultimately going to reverse and go in the other direction. That distance between your support and resistance points on a daily chart might be, 500 pips, something like that. Now that could go on for months to get that, or 1,000 pips. You're only under periods of really extreme angst where you're going to get more than 1,000. I mean, that's 10,000 bucks a full lot, right? So that's a lot of movement, and that really screws up the underlying commerce behind the price action, doesn't it? I mean, you're selling. Well, we're in that right now. I mean, in the pandemic that the world is in, there's an enormous shortage of computer chips for cars. So the whole supply chain is all screwed up, because if you can't get the computer chips to run the car, why would you need bumpers and other stuff? You got to shut the line down. So that drops the value of that company, because they're not producing cars. The companies that are selling bumpers, they're ready to send the bumper out, but they can't, because nobody's buying the bumper. So they're suffering, and the economy begins to suffer. And so maybe you'll get a 2,000 pip swing or 3,000 pip swing or something like that as the whole thing reestablishes and organizes. But it's going to turn around at some point, and it's going to come back as everything begins to stabilize. Because remember, it's not like real estate in New York. I mean, even that, I mean, you could get 20-30% drop in New York City. But in the aggregate, those are just blips in the upward trend of prices that are aggregating over the 20-year period of time or 60-year period of time, an average of about 8% a year in real estate. That doesn't happen in the Midwest. You don't get 8% a year appreciation. You're lucky to get 2 or 3. But then when the crashes come, you don't get 30% drops, you get 5% drops. You have to look at the market that you're analyzing and that you're in. How much risk appetite do you have? You know, if you're trading these currencies, you're looking at these two country pairs, and those are going to go to a maximum differential between the two countries, and then there'll be a reorganization. Well, the one country is going to get better in whatever it is that is affecting them, that's causing the price to go against that currency, and they're going to get better, and the other country is going to say, oh my God, now I've got to trade, you know, tremendous deficits because of trade, and I've got you know, interest rate problems, or whatever the thing is. So the one country that's having a tough time gets better, and the country that's having a good time starts to have tough times. And so that $2,000 or $3,000, you know, huge spike, or just the normal $1,000, say, pip spread, and we're talking about major pairs, not, you know, Turkish lira against the Taiwanese baht or something, or whatever the currency name is. But in normal circumstances, those two countries will normalize, and so the price over years is bound by, let's say, a 1,500 pip spread. I don't know whether that's the case or not, because I don't really care. I'm trading on a 5-minute chart. What the fuck do I care about what happened 2 or 3 years ago? And don't give me that stuff about prices repeat and patterns repeat, because they don't. That's folklore. It's too dynamic for that. Bob is at Citibank, and he's making a $5 billion trade, and he's going to try to satisfy that trade over the next 6 weeks, and he's certain things that he's got to do with certain commodities that the country is trying to trade, and that's what's causing that particular thing. Bob will be in the market next year with a $5 billion trade, but his trading pattern is going to be different and create different activity within the activity of the market, even though the amount of the trade or the client order may be the same dollar amount, is for a different commodity. And so the fact that the patterns may appear to repeat is random. Look, I'm a computer engineer, software engineer. I've written random number simulations, and you get repeating through random number presentation, you get patterns. I mean, I'm sorry that I have to laugh at this stuff, but the people that don't understand the mathematics behind chaos theory and randomness and you know, all the other stuff, as well as mixing that with supply demand, just don't get it. They think that there's some magic gremlin out there that's causing a head and shoulders pattern. They're going to look for that pattern. And the institutional traders aren't looking for those patterns. They're not. It's not happening. You know, I can look at these daffodils here, and I see a pattern. You know, well, they're yellow and they're, you know, whatever, they're beautiful and all that stuff. And they're gonna repeat on a macro scale. But if you look at each one, it's different. It grows different. They're different heights. The color texture is slightly different. It's called fractal. In mathematics, it's a fractal. It's a foundation of chaos theory and Claude Shannon's work in entropy and information. Call it information technology. It's not IT. It's the mathematics of information theory is what it is. And it turns out that his equations for information theory are the same as the equations in physics for entropy. Do some research, look it up. I'm going to explain it to you because it's not really relevant to your ability to be able to trade. It's more of a function of the way things work in the real world. You know, I'm out here recording in this windstorm. If you look at the trees in the background, those puppies are really moving. And you can hear the wind. So the question is, has my voice been drowned out by the forces of nature? Okay. Speaking of the wind, The wind has knocked over the chairs, and look, it's thrown the top of the chair way over here. I'll have to fix that at some point. Why don't I do that now? Peter, why don't you fix the chairs? Be back to you in a second. All right, chairs are fixed. So the question is, let's assume that let's assume that you agree with me that trading is not the mystical process of matching patterns and all that other kind of stuff, and that the two forms of price action that are normally recognized of trending price as opposed to trading in the chop or range-bound price trading are basically the same. And they are. Look, you know, trending as a trend within any particular time frame that you look at only occurs about 30% of the time, and then the price will go into some kind of a chop. So, and we've seen that in the chop are many trends. So, if the real big trend only happens 30% of the time, and if 30% of the time on a very short time frame, like a 5-minute, is just creates a correspondingly narrow range of price action on a chop, then it would seem to me that the base condition of price action negates trending. Well, wow, wouldn't that make life simpler if that was the case? If you could trade everything the same way. There was a book written a long time ago, Nicholas Darvas. He was a dancer back in the 30s or 40s or something like that. How I Made $1 Million Trading Stocks. And basically it was a range transition trading process. Prices trending, and once it broke out of that trend and went in above that, he'd trade that to the next range. And if it fell back in within the box, he'd trade the range between that line and the next line. It was support resistance. That's all it was. And the boxes he was forming were simply encompassing those areas of support resistance. And so, do you have support and resistance zones on a daily chart? Yep. Do you have them on an hourly chart? Yep. Do you have them on a 15-minute, a 5-minute, a 1-minute? Yep. Do you have them on a 5-second chart? Yep. Why? Because mathematically it's fractal. And even in a random number generator, you're still going to produce those characteristics, because that's just the way the randomness falls. If I flip a coin 1,000 times, it's going to come up about 500 times heads and about 500 times tails, to the point where the differential is statistically insignificant. If I flip the coin 3 times and it comes up heads twice, that doesn't mean that the heads is 2/3 more likely. See, it's really blowing up out here. Maybe what we'll do is transition inside so we can finish this in a little bit more calm manner. So I'll catch up with you inside, right? So inside with a cup of coffee to warm me up a little bit. That wind was pretty brisk. It was 33 this morning, and degrees Fahrenheit, and the wind has been going on for a couple of days. It's been it was 32 with a wind chill of I think 19 last night. So this is really pretty cold for April, and hopefully tomorrow we're going to see 70 degree weather, and things will be much better. Things having to do with price action and trying to simplify the trading. I'm just telling you what I do, what I look at, because I've tried to do the trend process on the longer term stuff, and I haven't had success with it, because what happens is that though I can catch a good entry point and have that trade go 30 or 40, 50 pips, the longer the trend, the deeper the reversals are. The more that price goes up, the more, and then you get this, and then it'll go. And so those reversals, it'll go 40, 50 pips, and then it'll come back 20 pips. And so, okay, so it's gone up 40 pips, and it comes back 20. So you hold, and it turns around, and it continues and goes back up, and 10 pips, and then it turns around and goes back down again. And now you're down to about your break even. Now what do? Are you in a reversal? Or what are you going to do? You're not trading for 20 or 30 pips, you're trading for 200. You had the trade the trend established, and so if you're looking for a 100 pip or a 200 pip win, your stop's got to be 50, 60, 100 pips. If you're looking for a 200 pip gain, then you better have a 100 pip stop loss, right? I mean, that's the quote best practices, which I think is bullshit. This risk-reward stuff is complete nonsense. But regardless of that, why would I risk at the point where it starts to go? I've sat with that trade as it's gone up to 50 pips, and it turns around. It's bounced a couple of times. It's come back to my take point. I'm break even. Now it's gone through that 20, 30, 40 pips. What am I going to do? I'm going to get out. I've got a 100 pip stop. I'm only halfway through there, so I'll wait. So now it's gone to 80 pips against me. That's $800 a lot. If I'm doing 10 lots, I'm $8,000 down. I mean, I don't care what the percentage is. It's $8,000. Come on. That's a lot of money. And so, again, because price action is fractal, I get the same patterns, so-called patterns, on a 5-minute chart as I will on a daily chart. I mean, that's just the fact, that's just the way it is. And you'll get them on a 5-second chart too. Now, the traders who say, well, there's too much noise down there are incorrect. That noise is just a fractal representation of price action at the smaller time frame that's duplicated on the daily chart. The reason they call it noise is because you can't trade that. You can't trade that 5-second chart because your spread's still going to be the same. Call it a pip or a pip and a half. So you're 3/4 of a pip to get in and 3/4 to get out. Regardless, it's a pip and a half, and the 5-second chart might have a half a pip ATR. Let's give it a 1 pip ATR, which I think is more appropriate for a 1-minute chart. But let's just, for argument's sake, you've got a 1 pip 5-second ATR. So that price is moving 1 pip at a time, and so it goes up 5 pips, and then it turns around and it comes down, and it'll come down. All you got to do is change the ATR on that for a more active thing, and you're out of that 5-second trend. Okay, unless you've got a tremendous amount of order flow, that 5-second chart is not going to trend up infinitely. Even if the 15-minute chart is trending up, strongly trending up, that 5-second chart is going to have 10 pip reversals, 20 pip reversals, because that's just the nature of the game. And so the question is, are you trading the trend or are you trading the swings? If you're trading the swings on the higher time frames, well, that's fine. But you can't do that on a 5-second chart, and it isn't because of the noise. It's just that your fractal view of price action at that point is so small, and your cost of trade, a pip and a half, the VIG that you're going to have to put in at 5 seconds to grab 3 pips or whatever it is, you're losing half your profit move just in the VIG. And so it becomes uneconomical to trade on the 5-second chart if you're scalping. Why would you trend trade on a 5-second chart or a 1-minute chart even? You know, that just doesn't make it. Or a 5-minute chart. You might be basing some of your information and gaining some of your confidence as to the trade that you're currently entering. If the overall price action is in an upward trend, then it's more likely in that 5-minute price action that you'll get a stronger move in the upward direction than you would in the lower direction. And so the probability then is that you're going to be a long trader in that particular reference frame. The thing that you don't want to try to do is counter trend to that, because you can't pick the top and you can't pick the bottom. And I've had a lot of failure. Most of my failures as a result of being successful as the price is moving in a direction and getting out and taking a profit, and then looking and saying, oh, this is going to continue, and getting back in, and then boom, then you get a big reversal, and then you're done. Those were in my early days of trading, and I've since figured out how to manage that better. But in the long run of things, that was one of the things that helped me say that there really isn't a difference in the trend trading as opposed to the range-bound trading, unless you're going to adopt Richard Dennis trend methodology, which even he says today doesn't work anymore. Or it works, but it's not as efficient. And the risks that you take, I mean, those guys, the turtle traders, were taking enormous risks and suffering enormous losses. But in the long run, when you're able to have these trending markets move over a long period of time, and you're constantly adding into the position as it moves forward, when you finally get one that runs all the way, and you've come in with your 4 positions, your 16 full lots, or whatever it is that the allocation for those guys was, and that sumbitch just keeps running up. The amount of money that they made was enormous. But you had to suffer huge declines. You got to remember that Richard Dennis, at the end of his career, he had taken his account to $200 million, and he had some money that he was managing for people too, but he made a lot of money of his own net worth. But he ran into one of these massive turns against, after he had a really substantial position on. There probably were those inevitable 6 losses in a row that you have, even if it's over a year period of time. You're over 3, 4, 5, 6 months. You're adding into your positions as that thing is going, and he lost half his net worth at that point. His account went from $200 million to $100 million, and then he returned all the money to his investor, and he said, I'm not interested in trading anybody else's money. I'll just take my own money. And even his investors were saying, we can't take these 20, 30, 40% drawdowns. That's just crazy. You made us a lot of money, but my stomach just can't take that drawdown. And he was impervious to those drawdowns. Well, if you got $100 million and you lose 20%, you still got $80 million left. That's a shell. Even if you had $10 million, you'd have $8 million left. So, trading the way some of these guys trade, and listening to them about these trends that they catch and trade with, and you're trying to trade with a 1 lot or a couple of minis, it just doesn't work. If you're going to trade in a trend basis, you absolutely positively can only trade with about 10% of your overall bank, because you're going to bust it out. Tom Algard is an example of that. You watch some of his videos, and And they ask him, well, how many times have you gone broke? How many times have you flatlined an account? He says, I lose an account all the time. But he's not trading with his whole account. He'll trade with, I don't know, 30. Let's say he trades with $30,000, but he's got a $100,000 or $200,000 account. And he's dealing in Cronus on it. I'm not sure what the exact transition is. So he drops that account. He comes and he goes to the bank and he brings. Let's say he drops $30,000. He goes to the bank, brings another $30,000, and then he trades that. But when he trades it and he's successful the way that he trades, he'll make 10 times the money. So you can dump an account multiple times as long as your overall system statistically over the long run is good, and that will enable you to make far more money when you win than the number of times when you lose. But that's just basic money management. That's just having an identified edge in your trading. And you have that whether you're doing a long-term trade or whether you're doing trading in a range-bound system. But all trading, even if you're trading in a trend, you're going to be trading within a range-bound system because somewhere along the line the trend stops. Or you just decide to get off the bus and form the range for yourself. So if you're looking at trading and you want to simplify your life a little bit, put all the educational stuff away about trending and range bounds and all this other, and just look at price action. Get the indicators off, because all the indicators are doing for you, honestly, is telling you what happened in the past, and because of the fractal nature of pricing, it's everything is going to be the same, although it's going to be different. So indicators are only telling you what happened in the past. They're not going to. They may tell you, oh, you're going to see a head and shoulders pattern, but you won't know until the pattern is completed and it's already on its way. So if you're trading on a short-term time frame, it doesn't do you any good. If you're trading up on a longer-term time frame, the chop that's created by the top of the head and shoulders pattern will decimate your account while you're waiting to see what exactly it is that's happening. So you need to simplify how you look at price action so that you can get your arms around mentally and emotionally what you're trying to accomplish. Don't complicate your trading. You can't do that as a retail trader. As a bank trader, you have more considerations toward the fundamentals of what is going on in the market as to whether you're going to be able to facilitate your client order at that particular time and at that particular price or not. If you can't at that price, you have to create conditions to fade everybody so that you can get the price down to a point where your client says, yeah, if you can get me this price, I'll take that. That's the economics of the Forex market that a lot of people say the Forex market is rigged. It's not rigged. These guys are just doing their job. It's like a real estate broker going out and showing you houses. He's trying to facilitate the market. He's talking to the seller. He's going to say, hey, this guy isn't willing to pay your price. This is the price he'll pay. If you don't take it right now, we're going to go to door number 2. And so it doesn't make any difference. It's for sale. And that's what's going on in the currency markets. One of the currency pairs is for sale. Are you going to buy it, or are you going to wait until it's at a better price? Or are you going to sell it because it's at the best price that you're going to get? We're having that happen right now in the real estate market in the United States. If you look at what's going on in the New York, particularly the Hamptons area, there was just an article on Mansion Global that was talking about if you want to sell, now's the time to sell, because the buyers are, there's little inventory on the market. There's an enormous number of buyers that are bailing out of New York City. They want to get into the Hamptons. They've got money to spend, and that's driving the prices up. If you want to get out, now's the time to get out, because once everybody's got what they want, and we're 15% behind in housing construction right now. Lumber prices have gone up 30%, 40% in the last 4 or 5 months. It's crazy. The thing is crazy. At some point, all that will catch up, and then it will become a buyer's market again instead of a seller's market. So it's time to sell now. might not be time to buy, but if you have no other options and you're looking for a place to live, you got to pay the price. So while that market is occurring, both parties are going to win until the music stops, and then that guy that paid $10 million for that house, and that house falls and it's only worth $8 million now. If he's got that much money, he's paying $10 million for a house, he isn't going to be selling. He's not trading the house. He's going to live there for 5 or 6 years. And then over the long term of the 8% a general appreciation of real estate, and it might be a little bit higher in a place like the Hamptons, but you can only bid that shit up so high until everything's got to come flying down. Over the centuries, I mean, I don't know what the colonists paid the Indians for Manhattan, but it was probably the equivalent of what a house would cost you today. And they bought the whole island, and now you can't even find a studio apartment for under a few $100,000. Just be realistic and rational about how you're looking at price action. What does that price action represent? It's commerce. It's global commerce. And so that within itself forms a range for the particular price pair that you're trading and the range of the prices for that currency pair. That may be totally different for another currency pair because the economies are different. But your trading has to be the same. Don't make any difference whether it's stocks or commodities or currencies or old tires. It's trading. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.